Hello, everybody. I'm Jeff Hirsch. We're here live at the Money Show Orlando with my friend Louis Navellier, and he's at NavallierGrowth.com if you want to know everything about him. And let's just look at market outlook a little bit here. You know, we're February. We had our State of the Union. We had our impeachment trial. We got a little coronavirus. We got some Fed talk going on. What's your outlook? What do you think about interest rates and the market for 2020?
Well, let's start with interest rates. The main thing folks need to know is that the global rates are still falling. There's a lack of confidence in Europe. They're at a 6-year low. Weak retail sales, weak manufacturing. Just a lot of problems. Obviously, they had Brexit. And the negative rates in Europe are causing capital flow in America, which is keeping our rates down. So our Federal Reserve promised to stay on the sidelines this year. But the truth of the matter is that, you know, the falling global rates puts pressure on them to cut rates. So
or at least be accommodative.
Absolutely. So that's very bullish. So we'll have a strong housing sector, lots of mortgage refinancing, all that kind of stuff going on. But it also fuels stock buybacks. I have very bullish forecasts on the Dow. We have to go to 40,000 for the Dow's dividend yield to equal the 10-year Treasury. I mean, it's ridiculous.
40,000? Remember 38,820?
Yeah.
Super boom?
I know. You're very precise.
That's just a throwback. But you said Brexit. Any take on how that finally went down? It seemed kind of quiet.
It is quiet, but here's the deal. There's a big bureaucracy in Europe, and Brussels especially, and a lot of people are hoping that Britain can become the Singapore on the Thames. We're basically a gateway to Europe without all the bureaucracy. So we'll see how that works out, but the Brits are happy to be free, and they don't want to pay in anymore. There's going to be layoffs. It is what it is, but it's the reserve currencies of the world are the US dollar, very strong, higher rates, good central bank, and Britain would be right after us. Their rates aren't as high, their central bank's going to be cutting, but at least it's better than negative rates,
Much better than negative rates. That's why everyone's flocking here.
Correct. So this sets the stage for a very bullish market. The elections are good for the market because they're all going to suck up to us. And
doesn't hurt that there's a sitting president running for re-election,
who's a cheerleader for the market, and
government spending's up.
Correct. So, and then year-over-year comparisons getting easier. So we're going to have a lot of good earnings.
You think earnings forecasts are going to improve a little bit? I mean, there's some talk.
Yeah, we've had huge surprises, and the guidance has been largely good. This is 1999 all over again.
So as big as last year, perhaps?
No, 1999.
I know 99, but I'm saying last year was pretty big, too.
Yeah, but 99 was better. I had a couple portfolios up over 100% that year. So there are bubbles forming. Obviously Tesla's a short covering bubble. We personally think people should probably wait till it gets added to the S&P. If it has 2 more profitable quarters and get added to the S&P, that'll be the last hurrah, and because competition's coming for them. But it's probably okay to hold it for a while.
So, you like Tesla?
I don't like Tesla. I wouldn't recommend it, but I think it's a bubble stock. It's going to get pricked. You see it oscillating.
Right.
But if you're looking for an exit point, it's when it gets added to the S&P maybe later this year.
Okay. Thanks, Lou.
Good to be here.
Appreciate it, everybody. Thank you.